In March 2026, Ripple recorded the most profitable quarter in its history, tripling its revenue and reaching a $50 billion valuation. This growth was driven by $2 billion acquisitions, Hidden Road and G Treasury, alongside the adoption of Ripple's infrastructure by global institutions like Deutsche, Aviva Investors, and Société Générale. During that same period, the XRP token declined sharply, dropping 60% from its cycle top. Technical indicators show the asset stuck below its moving averages, while sentiment has reached extreme market fear, registering just 14 out of 100. Why does the native token lose more than half its value at the exact moment the underlying company achieves record levels of institutional penetration? This divergence is not a result of manipulation or a market bug. It is a structural reality built into the ecosystem, one that most investors overlook. To understand the price, you have to separate Ripple, the private corporation, from XRP, the public token. They are two distinct financial vehicles. The revenue generated from Ripple's new clearing and treasury services flows directly into the company's private balance sheet. It belongs to Ripple shareholders. These corporate profits are not used to purchase the token on the open market. They do not increase the token's market capitalization. This creates a disconnect for retail investors, who often buy the token under the assumption that it provides direct exposure to the company's software revenue. To accurately project the value of XRP, you have to ignore Ripple's corporate earnings and focus exclusively on the network settlement architecture. A common misconception suggests that any bank partnering with Ripple creates immediate buy pressure for the token. The transaction data shows a different reality. When Tier 1 banks use Ripple's infrastructure, they adopt the software rails. They settle value in fiat or rlUSD, bypassing the token entirely. There is only one product requiring the token to function: on-demand liquidity, or ODL. ODL utilizes the token as a neutral bridge asset, allowing for the instant conversion of one national currency into another. Currently, ODL is used primarily by remittance companies in emerging markets like Bitso, rather than global banking giants. As long as institutional volume routes through the software and stablecoin pathways, corporate growth will continue to leave the token behind. Given the current lack of institutional ODL usage, the token's poor price performance appears logical. But beneath that price action, on-chain metrics show a high level of aggressive activity. In a 2-month window, available exchange supply experienced a 56% collapse, falling from 3.76 to 1.64 billion. This suggests large entities are shifting assets into private, cold custody for long-term accumulation. Meanwhile, the underlying ledger has reached a record of 4 million daily transactions. The network's native stablecoin also reached a $1.42 billion market cap, demonstrating real utility on the network rails. While retail traders sell based on the falling price, major players are accumulating the base asset and stress testing the infrastructure. What will it take for Tier 1 banks to move from fiat pathways to the token bridge? A severe lack of clear federal regulation currently prevents major U.S. banks from routing billions through the XRP token bridge. The Clarity Act establishes a permanent framework for stablecoins in the United States, setting the legal standards needed for digital settlements. Without this legal cover, U.S. institutions face high compliance risks if they use a public token for international payments. The passage of this act would remove that barrier, changing the token's status from a speculative asset to a tool with institutional utility. Ripple is also moving outside the U.S. to generate immediate demand, targeting African remittance corridors where the average fee is nearly 9%. The underlying technology is already fully in place. The shift to macro adoption is now a regulatory waiting game, centered on the outcome of the Clarity Act. Moving from regulatory theory to hard mathematics provides a clearer look at what various price targets actually require. To reach $10, XRP needs a $614 billion market capitalization. That is larger than Sweden's entire GDP. A $30 target requires $1.8 trillion. At $100, the market cap reaches $6.1 trillion, exceeding the economic output of Japan. Institutional analysts project a more conservative near-term range between 1.20 and 2.60, with a potential breakout to $5 or $8 if ODL adoption expands. To navigate this market, you must move past triple-digit targets and anchor your strategy to mathematical limits and adoption timelines. The asset's future is binary. Either the legal framework passes and institutional demand increases, or the current disconnect remains and the token stays stagnant. There are 5 metrics you must monitor to determine which scenario is unfolding. Indicator 1 is the progress of the Clarity Act through the U.S. legislature before the May 2026 deadline. Indicator 2 is the growth of ODL volume in Ripple's official quarterly reports. Indicator 3 is the trend of exchange supply. You need to see if institutional accumulation continues or reverses. Indicator 4 is the migration of commodity settlements onto the meat of ledger. Indicator 5 is the official activation of those 8 African remittance corridors. Acquiring assets during structural fear historically offers high returns. However, failing to monitor these 5 metrics could result in holding an obsolete asset. Capital preservation must always remain your priority.